Good evening and a warm welcome to everyone present here. We would like to take this opportunity here to thank BSE IPS for giving us this platform, and we welcome you all for another investor education sharing session by Bonds India. We intend to cover some fundamentals around inflation and its impact on your investments. I'm Shelly Ved and I handle the trade desk at Bonds India. Today I'm joined by my colleague Krish Haria. He's also a part of trade desk and he looks after the SLR segment. I'll give you a little brief about our company. So Bonds India is a new age fintech startup that aims to digitize the Indian bond market. It is one of the India's first online fixed income portal whose primary focus remains to simplify the bond markets for retail investors, alongside educating and advising them at each and every step. Our ultimate goal is to ensure complete transparency for investors, and we have high-tech integration with ICCL to provide real-time online trade settlement facility. We are really thrilled with the response that we received from our previous webinars, and we hope that we are able to add a lot of more value today with our current one too. So we'll begin our session today with the fundamentals of inflation. I'll just share my slides. Okay, so let's start our session with let's begin with what is inflation. So inflation is basically, inflation is a rate of change in the prices of goods and services. Now, it's a general increase in the prices of goods and services in an economy over a period of time. If an individual's rise in income is not keeping pace with inflation, his or her purchasing power would decline. So over time, inflation increases the individual's cost of living. Now, if the inflation rate is high enough, it hurts the economy. It's basically a loss of purchasing power of the currency, meaning that each unit of currency buys fewer goods and services. So I'll just give you an example. For example, a pen, which is costing rupees 5. Now, a pen which costed rupees 5, now it is costing rupees 10. There's an increase in the price from 5 to 10. So earlier, in 10 rupees, you could buy 2 pens. And now the same pen in 10 rupees, you can purchase only 1 pen. So this is how it affects the currency. Now, economists and our policymakers, they closely monitor the inflation as it can have significant impact on various aspects of the economy. Inflation can have both positive as well as negative effects on the economy. Now, mild or moderate inflation can be a sign of a healthy economy as well, as it indicates that there is sufficient demand and economic growth. However, when inflation climbs very fast, like it climbs faster than usual, it can lead to higher prices for fuel, groceries, clothing, and numerous other products and services, which pinches the common man. Basically, it erodes the purchasing power of individuals, reduces the customer's confidence, and this makes a long-term planning very difficult. Long-term investments and plannings become very challenging with this. So, see, we've demonstrated a very small example here. Say the cost of particular goods is rupees 100 right now. Now, with an inflation rate of 6%, it will become 106 next year. So I'll hand over to Krish now. So he'll explain you the causes of inflation and what are the levels of inflation which are witnessed in India.
Moving on to the next slide. So I will explain you why the inflation occurs. Right now, inflation occurs when there is a sustained increase in the price of price level of goods and services in the economy. Right, and there are several factors that can contribute to the occurrence of inflation. One of them being increase in the cost of wages, increase in cost of merchandise, and increase in cost of commodities. These are examples of cost push inflation, which we'll take up in detail in the next slide. There are also certain monetary factors that affect inflation. Now, inflation can also be influenced by money supply. Now, when the central bank, say for example, the Reserve Bank of India, increases the money supply in the economy by injecting more money, the increased money supply can result into more spending. And more spending, once there is a higher spending, the prices for those particular goods increases. Hence, it also increases inflation. Now, when demand surpasses the supply, producers may increase prices to capitalize on that high demand, and thus it results in inflation. There are also certain government policies, for example, that can lead to inflation. Now, for instance, we can take that there is an excessive government spending, or there is a large budget deficit, or there is a certain increase in money supply that takes place by the government. These are all situations that the government, in all of these situations that the government takes place, inflation can increase tremendously and in an unhealthy manner. If the central bank keeps the interest rates low for an extended period of time, it can stimulate borrowing. And when the interest rates are lower the interest rates, more the borrowing will be easier for the consumers. And when the borrowing is easier for the consumers, the spending also becomes easier. And when there is excessive spending in the economy, the inflation increases. Can we take the next slide? Here, I'm going to take up the types of inflation. Now, there are three main types of inflation in the economy. First one that we're going to take up is the demand pull inflation. Now, as the name suggests, it is a type of inflation that occurs when the overall demand for goods and services in the economy exceeds the available supply. It is typically driven by factors that increase the consumer spending, such as rise in wages, different expansionary policies, and also certain fiscal policies which increase consumer confidence. I'm going to give you a couple of examples over here that will explain what exactly demand pull inflation is. First is the economic expansion. Now, during periods of economic growth, increased consumer spending and business investment can drive up goods. When the economy is booming and higher disposable income, likely to spend more on automobiles or electronics, and which when they start more on automobiles or electronics and different incomes, the increased demand can outpace the supply capacity with inflation, upward price pressures. Let's take another example over here. Let's take the housing market boom, for example. Now, if, for example, there is a rapid increase in the population, right? When there's a rapid increase in the population or a sudden rise in demand for housing, due to favorable economic conditions, like if there are certain government incentives given to the consumers, or if there are lower interest rates that take place, it can lead to a shortage of the available housing units in the economy. When there's a shortage of the available housing units, the home prices can rise as potential buyers for those particular limited housing options will have fewer choices in relation to buying their house. Let's take up the next type of inflation, which is cost push inflation. Now, as the name suggests, cost push inflation is nothing but an increase in the cost of production, like labor, raw materials, or energy, etc. So if there is an increase in wages, for example, so when workers demand for a rise in their wages at a significant level, it can increase the cost of labor for businesses. Now, if businesses pass on these increased labor costs to the consumers by raising the prices of the commodities that they are selling, it can result in a cost push inflation. Factors such as strong labor unions, minimum wage increases, or labor shortages can drive up wages and contribute to the cost push inflation. Let's take an example of rise in raw materials cost. Now, if the price of essential raw materials, let's take an example of petroleum. Now, if the price of petroleum increases in the economy, the related industries which work with petroleum will also have an increase in the prices. For example, let's say transport. So public transport will become more expensive due to essential raw materials, that is petroleum, rise in price of the petroleum, right? So this is also one of the examples of cost push inflation. Let's look at the third type of inflation. The third type of inflation is built-in inflation. Built-in inflation is also known as inflationary expectations or inflationary pressures. It basically refers to a phenomenon where expectations of inflation become embedded into behavior and decision making of individuals, right? Now, in an economy that we are living in, it becomes a self-perpetuating cycle that can contribute to sustained inflationary pressures over time. let's take an example over here. Let me explain a theory that is ingrained in the built-in inflation. Let's take the theory called the wage spiral theory, the wage price spiral theory. Now, wage price spiral theory occurs when workers demand higher wages to compensate for expected price increases in the future, which they might have experienced in the past based on their past experiences. Now, if a consumer has experienced higher inflation in the past, he might expect similar or higher inflation in the future as well, due to which he might want a wage increase in the current scenario. Now, if the worker demands for higher wages to compensate for expected increases in the future, the employers must meet their wage demands. Now, if the employer meets their wage demands, the production cost will increase, and the business may pass on that increased production cost onto the consumers, which will lead to a built-in inflation increase in prices. And with this built-in inflation increase in prices leads to unhealthy increase in inflation as well in the economy. Let's take the next slide. Here, I'm just going to take up and explain certain parts of inflation that have occurred throughout the history of India. And I would like to put this and explain this in 4 different parts. I'm going to take up the post-independence period, which will be from the 1950s to the 1970s first. So now in the early years, after India's independence in 1947, the country followed a planned economy model where emphasis was put on import substitutions and industrialization of the economy. During that period of time, the inflation was quite and relatively moderate, and the inflationary pressure started to rise during the late 60s or the earlier 70s during that period of time, due to the Green Revolution period that was going on, and also due to certain oil price shocks that were not expected by the economy. There was a extremely high inflationary period from the 1970s to the 1980s. The inflation during this decade was almost in double digits. Now, when the inflation is in the double digits, it's a worrying factor for the economy. Now, factors contributing to this inflationary period included rising oil prices, higher fiscal deficits, increased government spending, and there were some supply side constraints that took place. The government implemented various price control mechanisms and also certain rationing systems to curb the inflation during this period. Post which there was an economic reforms period in the 1990s. Now, in the 1990s, India initiated a series of economic reforms to liberalize its economy and open up the Indian markets globally. Now, these reforms aimed at addressing various structural issues and improve the overall efficiency in the market. As a result, the inflation was brought down to single digits back again in the 1990s. And during this period, there was a norm for normal single-digit inflation period. Post the 1990s, in the 2000s, there was a moderate inflation, and there were periodic spikes in the inflation during certain events that took place over the period of time. For example, there were some supply side disruptions, or there was the 2008 crisis, or there was certain monsoon patterns which affected agriculture as well. And there were certain global commodity price fluctuations that took place, which affected India's inflation during this period of time. But over the period in the 2000s, there was certain relatively moderate inflation, except for the spikes that happened due to certain situations that were affecting it. I would like to explain the inflation in India in the recent years. Now, in the recent years, the inflation has been relatively moderate. But there have been signs in the past years, that was the post-COVID-19 pandemic period, where the inflation has been certainly high, and the government has had to take measures to control that inflation by increasing the repo rate constantly from May 2022 up until right now. In April 2023, the inflation rate had reduced substantially to 4.7% from March, which had an inflation rate of 5.7% and 6.4% in Feb 2023. So these repo rate hikes that were done by the government, these took time for the economy to get an impact on those repo rates. And once the impact was shown in the recent last 2 or 3 months, where the inflation has reduced substantially. So so now we would take up a role of RBI in curbing inflation, and Shaili would like to explain you about this.
So before moving on to monitoring of inflation, can we have a poll here?
Yeah.
We'll just conduct a short poll.
So what is one of the primary factors that can drive up the prices of goods and services and lead to inflation? The option 1 is increased demand for goods and services. Option 2 is decreased production costs.
We'll give 10 more seconds to this poll.
And we want everybody to participate and at least answer and give an attempt.
Yeah, we have majority of them. They're all 96%. So we'll end the poll here. We have 84% of our audience have been participated in this poll. And we are glad that 95% of them have got the correct answer. It is increased demand for goods and services. So, yeah, we'll move on to the role of RBI in curbing inflation. So central banks across the world are responsible for tracking and monitoring inflation for their respective countries. Now, in India, RBI through MPC is the Monetary Policy Committee, is tasked with keeping inflation under a targeted range. The Reserve Bank of India plays a very crucial role in curbing inflation in India. As the country's central bank, RBI is responsible for formulating and implementing monetary policy to maintain the price stability. So what they do is they set up a target inflation rate and they work towards it. They work towards achieving it. So to do that, they need to undertake certain measures. Now, RBI determines and it sets the key policy rates, such as the repo rate, the reverse repo rate. So Krish will take this up in detail in the subsequent slides. Basically, these rates influence the cost of borrowing and the interest rate in the economy. Now, RBI amends the repo rate to keep the inflation in check. So RBI increases the repo rate if inflation is more than the targets which is set by them. Now, by adjusting these rates, RBI aims to control the inflationary pressures and promote price stability. Now, lesser spending can decrease the demand. It can bring the prices down, and this can help to control the inflation. What central bank or RBI, what they do is they take relevant action around the monetary policy to curb inflation. Now, central banks, they also impose reserve requirements on the commercial banks. So it specifies the minimum proportion of deposits that the banks must hold as their reserves. So by adjusting these reserve requirements, central banks can influence the amount of money that banks can lend, thereby affecting the overall money supply in the economy. Now, higher the reserve requirements can reduce the lending and money supply, and this can help again in curbing inflation. Krish will explain this in detail in the subsequent slides.
So we're going to take up the relationship between the repo rate and the inflation. Firstly, I would like to tell you all the relationship between the repo rate and inflation is part of a much broader framework of the monetary policy, which aims to maintain the price stability in the economy and also inherently supporting the sustainable economic growth. Right? You do not want to ruin your economic growth of the country. Now, the central banks continuously assess and adjust these interest rates based on their analysis of the economic conditions and inflation dynamics to achieve their policy objectives. So now, the repo rate interest rate at which the central bank lends money to different commercial banks. It's basically interest rate at which the central bank lends money to different commercial banks in the economy, in the country. Now, it is one of the tools used by the central banks to influence monetary policy and manage the economy. Now, the relationship between the repo rate and inflation is complex and can vary depending on the specific economic conditions that we're living in and the effectiveness of that particular monetary policy transmission schemes. There are some key aspects that we can look into when we want to look into the relationship of repo rate and inflation. One of them is controlling inflation. One of the primary objectives of the central bank is to maintain price stability, which often involves managing inflation. Now, by adjusting the repo rate, the central bank aims to influence borrowing costs and consequently the overall level of the economic activity. Now, increasing the repo rate tends to make borrowing more expensive, which can create moderate demand. Now, once there is a moderate demand,
the screen is paused.
Just a second, I think we are lagging. Switch on and switch off the camera. Yeah, so we're back. So once there is, I'm so sorry. So which often involves managing inflation. Now, by adjusting the repo rate, the central bank aims to influence the borrowing cost and consequently the overall level of the economic activity that takes place. Now, increasing the repo rate tends to make borrowing more expensive, which can create moderate demand. Once there is moderate demand, it helps to potentially control the inflationary pressure on the economy. And conversely, vice versa, when we lower the repo rate, it can stimulate borrowing and it can stimulate spending, which will in effect put pressure on the price and inherently increase inflation. It will inherently increase inflation. So the second point that I want to talk about is certain transmission channels. Now, the transmission channel which I spoke about right now goes through from the bank, where everything is related to the interest rate, where the RBI takes the decision where they want to increase the borrowing cost or they want to reduce the borrowing cost. Now, whatever borrowing cost increase or reduction takes place with the banks through the repo rate increase also goes up and ends up with the end consumers, because borrowing becomes more expensive for the end consumers in the end, because when the bank is borrowing at a higher cost, it will lend at a higher cost. I want to talk about the current scenario of the repo rate. So I think since the first rate hike that took place, from then on, we have had 6 major rate hikes to control the inflationary pressure in the economy. And most recently, right now in Feb 2023, there was a last rate hike that took place, which increased our repo rate to 6.5%. And 3 years ago, the repo rate stood at 4%. So there was a 250 basis point hike in the past 3 years. And right now, in the past 2 months, we've had the first rate pause that took place by the MPC. And right now, as of today, where we're standing, we had the MPC policy decision today as well, where there was another rate that we have had in the economy. And the inflationary pressure that has certainly reduced over the period, and we can see a month-on-month improvement in the inflation as well. So there was no need for a rate hike as the inflation is under control and the economy of India is booming at this particular point of time.
Yeah.
So we would like to explain the time lag effect. Now Shaili will take over and explain you what the time lag effect is.
So the relationship between the repo rate and the inflation may not be immediate or very instant. So change in inflation after a rate hike, it comes with a time lag of few weeks or say few months also. So monetary policy actions typically take time to influence the economy. Now, changes in the repo rate may sometimes take several months or even longer to fully impact inflation. Therefore, central banks often need to assess the expected future path of inflation and adjust the repo rate accordingly, considering the time it takes for their policy actions to affect the economy. RBI's continuous rate hike since May 22, it took few weeks time before the inflation rates showed inverse traction. Even when RBI paused the rate hikes in April 23, we saw a fall in inflation rate because of the effect of previous rate hikes.
Right.
Can we conduct the poll here?
Yeah, we can conduct a poll.
Yeah. I'm just pressing this.
So which organization in India plays a significant role in monitoring and curbing the inflation? First is the Reserve Bank of India, and second is the Securities and Exchange Board of India, which is SEBI. I think this is fairly easier for our viewers, and I think we'll give you 15 more seconds for this.
We'll end the poll here.
Yeah.
So 97% of our audience is right. It's Reserve Bank of India,
Which is the central bank, and it is one of the most important organizations to play a significant role in monitoring the inflation in the country.
Yeah. So now we move on to the most important session around bond investment and effect of inflation on bond investments. So bonds provide a fixed income stream through their periodic investments, periodic interest payments, such as monthly, quarterly, semi-annually, annually. It depends upon the bond that you are choosing as per your future goals. Now, this predictable cash flow can be very appealing to investors seeking a stable and a regular income. Income, they would want the income to cover either their regular expenses or to meet their financial goals. So investors want their wealth to grow. Now, for a positive wealth creation, your post-tax returns or a return on any investment should be higher than the rate of inflation. So when the post-tax rate of return earned by an investor is lower than the rate of inflation, it means that inflation is not keeping up with your cost of living, with your rising cost of living, you can say. Now, on the other hand, when the post-tax rate of return is higher than the rate of inflation, the investor's wealth is growing in real terms. Now, with inflation being around 5 to 6%, one needs to invest in securities or assets that grow more than 6% per annum. Post-tax returns from fixed deposits fail to match inflation rates. For example, I'll just give you a little example. Say if the fixed deposit is giving you a 7% interest rate, then on an investment of say 1 lakh rupees, you will earn 7,000. And if you're in a tax bracket of 30%, then after paying that 30% tax, that is 2,100, you will be left with 4,900. Or you can say you're earning 4.9%. Now, on the other hand, bonds will give you a higher yield. Say you go for a AAA rated bond or a A rated bond, and say you have a yield of around 10%. Then on 1 lakh, you are making 10,000. And after deducting 3,000 tax, which is 30% tax, you'll be having 7,000. So the average inflation over here, it has to be lower than 4.9% for your positive wealth creation. Now, like bonds, say PSUs, corporates, GSEC, they're all the right vehicles to drive growth in an investor's wealth. Also, fixed income securities, they carry less risk and it provides stable post-tax returns, which will help an investor's portfolio to grow optimally. Move on to the next slide. Now, what happens to bond prices if the inflation is high? So in the next two slides, we will see the impact of inflation on the bond prices. Now, when the inflation increases, the bond prices fall. So when inflation is high, RBI will hike the interest rates. This will lead to the newer bond issues coming up with higher coupon interest. Now, while the older issues are fixed with a certain coupon rate, they start to trade at a discount because they want to match the yields which are generated with the newer issues. So this will lead to a fall in prices of the bonds with an increased inflation and the interest rates. So I'll just explain you this with the help of a little example. Now say company A has issued a bond for 2 years at 9% per annum in say, April 2022. Now RBI started to increase rates from May 2022 to curb inflation. Now the repo rate has increased from 4% to 6.5%. That is 2.5 percentage points in period from May 2022 to May 2023. Now, if the same company A, if it wants to issue an additional bond now in May 2023, will have to provide an interest rate of say probably 10.25 to 10.75% for a 1-year bond. Now, what happens to this bond issued in April 2022? The tenure left for that bond is till May 2023, that is 1 year. Whereas, and this 1 year, and this is one, and the one which is issued in May 2023 is at a higher interest rate. So to bring April 2022 bond at par with the new issue of May 2023 in terms of yield, the old issue, that is the April 2022 bond, it will be sold at a discount. So the inflation will lead to a reduction in prices. It will lead to a reduction in bond prices. Now, let's see what happens to bond prices when the inflation is low. So, the same company, let's take the example of the similar company. Say the same company A has issued a bond for 2 years at 10.25% per annum in May 2023. Now, in reducing inflation scenario, RBI started to reduce the rates from May 2023 to curb the inflation. So the repo rate assuming decline from 6.5% to 4%. That is again 2.5 percentage points in period from May 23 to May 24. Now the same company A, it wants to issue an additional bond in May 2024. They'll have to provide an interest rate say of 9 to 9.25% for a 1-year bond. To bring the earlier bond at par with the new issue in terms of yield, the earlier bond will start, it will be sold at a premium. Thus, the reduction in inflation, it will lead to an increase in bond prices. Like say today was our RBI's policy and they has announced a pause in rate hike and repo rate remain unchanged. So when inflation is receding, RBI will either announce hikes on the hikes, or it will announce the rate cuts. Now, this leads to newer bond issues come up with lower coupon rates due to the reduced interest rates by the banks. While the older issues, they're already fixed with a certain coupon rate. They get an increased demand due to the higher interest rates. So the bond prices go up on account of high demand and it starts getting traded at a premium. So in a low inflation environment, bonds become more attractive because they have more attractive returns compared to the other investments. This can lead in investors allocating more of their portfolios to bonds, driving up the demand and potentially increasing the bond prices. Vish will take up these slides. You want to conduct one poll here?
Yeah, you can do that.
We'll just conduct one more poll.
So what is the relationship between the repo rate and inflation in India? Repo rates have a positive correlation, or the repo rates and inflation have a negative correlation.
This seems to be a bit tricky for our audience here, but yet the majority has been on the right answer. We'll give 10 more seconds to this poll. Yeah.
So I think we'll end the poll over here. and only 55 to 60% of you all have gotten this right. And basically the right answer is that repo rates and inflation have a negative correlation. So basically when the repo rate increases, it is basically to curb the inflation. The RBI takes this step to curb the inflation, and hence they have a negative correlation. Moving on, we'll just explain the inverse relationship of price and interest. Now, there is an inverse relationship between price levels and interest rates, which means that when interest rates rise, price levels tend to decrease, and vice versa. This relationship is often referred to as the price interest rate relationship, or in the economic term, it's called the Fisher effect. Now, there are two perspectives to consider over here. First is the borrowing and spending. Like I explained earlier, when interest rates are low, borrowing becomes cheaper, which can stimulate consumer spending and business investment. Now, increased spending and business investment can lead to higher demand for goods and services, potentially pushing the prices upward. And conversely, vice versa, when the interest rates are high, borrowing becomes more expensive, which can discourage consumer spending and business investments, which can lead to lower price pressures, and hence the inflation is moderate. The second point that you have to look at over here is the inflation expectations. Now, what is inflation expectations? So now when interest rates can be influenced by inflation expectations, it is expected that, for example, central banks may increase interest rates to combat those inflationary pressures. Now, for example, higher interest rates make borrowing more expensive and it slows down the spending. Now, what happens when it slows down the spending? The inflation gets under control and it helps reduce the inflationary pressure and stabilize the price in the economy. On the other hand, when inflation is expected to be low, central banks may lower the interest rates to encourage borrowing and stimulate the economy, which can contribute to price increases. Now, it's important to note that relationship between price and interest rates is not always so straightforward. And there are other factors that can influence the relationship between price and interest rates, like the economic growth, the monetary policy decisions that the RBI is taking, the market conditions, and the investor sentiment at that particular time in the economy. Let's move on to the next slide. So how does the GSEC yield get impacted by changes in inflation? The yield of the government securities, also called as the GSEC, can be impacted by inflation in several ways. So now inflation influences the yield of GSECs primarily through its effect on the interest rates and market expectations. So there are two ways that the GSEC yield gets impacted. Actually, there are a couple of ways. We'll look at it one at a time. One is the real interest rate. Now, when inflation erodes the purchasing power of money over time, and when inflation rises, the value of the fixed interest payments that the consumers are receiving decreases. To compensate for that loss of purchasing power, investors typically demand a higher yield on the GSEC. As a result, the GSEC yields tend to move in tandem with the movement of the inflation. So higher the inflation, higher will the GSEC yields move. Second, we can also look at the central bank policy. Now, central banks often respond to inflationary pressures by adjusting the monetary policy, particularly the interest rates. Now, when inflation rises, central banks may tighten the monetary policy by raising the interest rate to curb the inflation and to anchor inflation expectations. Now, higher the interest rates can rise, GSEC yields as investors demand higher returns to compensate for that increased cost of borrowing that the banks have passed on to the end consumers, which can inherently reduce the economic growth prospect of the country. There are also certain market expectations. Now, so these were the positive sides that I was showing you, where inflation and GSEC yields move in tandem. Now, there is also another side that we can look at it. If market participants anticipate higher future inflation, they may demand higher yields on GSECs to protect against the eroding of the fixed income payments, as I had explained earlier, right? And market expectations on inflation can also be influenced by factors such as the economic indicators, the monetary policy, the fiscal policy, and the global commodity prices, like oil prices in the economy. The demand and supply dynamics also take place, where, for example, if inflation can impact the demand and supply of the GSEC, right, thereby affecting the yields. Now, the higher inflation can reduce the attractiveness of fixed income securities. leading to a decrease in demand for G-Secs, right? When there is a decrease in demand for the government securities, which is the opposite of what I had just explained earlier. When there's a decrease in demand, the attractiveness of the G-Sec falls, which puts upward pressure on the yields. So decrease in demand increases the yields and reduces the price of the G-Secs. Conversely, if investors expect inflation to rise significantly, they may seek the relative safety of G-Secs, increasing demand and potentially lowering yields. There is also market sentiment that takes place. For example, inflation can also influence the market sentiment and risk appetite. If inflation is perceived as a threat to economic stability in the country, like during this period, our inflation, when the inflation was extremely high, it was not a threat to the economic stability of India. Different countries had threats to their economic stability and still are going through some threats ongoing at the moment. So investors may become more risk averse in those countries, and they seek safety of government bonds, including government securities. And this increased demand for G-Sec can drive down the yields. Now, it is important to note that G-Sec yields are influenced by multiple factors apart from inflation that I just mentioned earlier. This is just a comparison that we're doing. The different factors also include the economic condition, the monetary fiscal policies, the global market trends, and the market and investor sentiments. Therefore, while inflation is a significant factor, it is not the sole determinant of G-Sec yields in the economy. Now, we'll look at the relation between G-Sec, inflation, and repo rate in tandem. Let's look at G-Sec yields and inflation first. So the yields on the G-Sec are influenced by various factors, including inflation expectations. Now, when inflation expectations rise, bond investors may want higher yields to compensate for eroding purchasing power of their future cash flows that they're going to receive in the government securities. Now, as a result, the government yields tend to move in tandem with inflation, as explained earlier, and higher inflation expectations can lead to higher government yields. Second, we can look at the repo rate and inflation. The central bank sets the repo rate with the aim of controlling inflation and ensuring the price stability. Now, when the central bank expects inflationary pressure to rise, it may increase the repo rate to tighten the monetary conditions and reduce borrowing and spending. Now, by increasing the repo rate, the central bank aims to curb the inflation, and conversely, vice versa as well. So the impact on G-Sec yields changes with the repo rate, and it can have an indirect impact on the government securities. When the central bank increases the repo rate, it affects the overall interest rate environment, including the market interest rates. Higher repo rate can increase borrowing costs for banks and other market participants, potentially leading to higher yields on the government securities. The relationship between G-Sec yields, inflation, and repo rate is complex, and it can be influenced by all these factors that I had mentioned earlier. And all of these factors influence the government yields and in the inflation in the economy. Now, Shaili would like to take up the global impact of inflation in the Indian markets.
We'll conduct a poll before that.
Yeah.
We'll take a poll here.
So we'll just conduct a poll over here.
So what happens to bond prices when inflation is high? Bond prices rise as interest rates decrease, or bond prices fall as interest rates increase?
I think that's good enough. And we can end the poll.
Yeah, so 70% of our audience here has got the correct answer. We'll quickly conduct one more poll over here.
So how does the price of bonds change in relation to interest rates? Option A, the price of bonds falls when interest rates increases. Option B, the price of bond rises when interest rates decreases. Both, and option C, both A and B.
It's quite similar to earlier. We'll give 10 more seconds to this poll. We'll end the poll here. So yeah, the answer is both A and B, and 76% of our audience has got the correct answer. Excellent. Yeah. So let's understand the global impact of inflation on Indian markets. So first, let's see what is the impact on stock market. Now, inflation can affect or impact the valuation of stocks, because global inflation can influence the interest rates. Central bank in different countries may respond to inflationary pressures by rising the interest rates. Sorry. Global inflation can impact investor sentiment and risk appetite. So this can, make investors become very cautious due to uncertainty of their future economic conditions. Now, if global inflation raises concerns about overall economic outlook, it may result in a shift in the investor sentiment, leading to selling pressure in the stock market. So all this can influence the FIIs, that is the foreign institution investors. It can influence their investment decisions in emerging markets like India. Now, if global inflation leads to higher interest rates in developed economies, it can make their own domestic markets relatively more attractive for them for seeking higher returns. So this can result in capital outflows from the emerging markets, including India, potentially affecting our stock prices. Now, let's see the impact on Indian rupee. So high global inflation can lead to currency depreciation for the Indian rupee. Now, when inflation is higher in other countries compared to India, it can reduce the relative value of our INR. Now, global inflation can influence capital flows into and out of India. Now, if inflation remains high, a potential increase in, say, US rates could hinder the foreign investment foreign portfolio investor, that is our FPI's flows, and corporate dollar raising plans, potentially leading to the rupee depreciation. Global inflation can also impact India's import costs. So if there is a very high inflation in other countries, it can lead to the higher prices for the imported goods and commodities, such as, say, oil, metals, and all the agricultural products. And India is one of the major importer of these items. So, and these increased costs can put a pressure on our INR. So when the import bills rises due to the higher prices, it can lead to a larger trade deficit, and which can negatively affect the Indian rupee. Now let's understand the impact on debt market. So global inflation can influence interest rates in debt market. So when inflation is very high globally, central banks may increase the interest rates to curb the inflationary pressures. The Indian debt market has seen an increase in participation from domestic institutional investors such as insurance companies, pension funds, mutual funds. So this diversification of investors helps reduce our influence on the global inflation for the market. Now, Indian debt market is particularly impacted by rising US inflation, resulting in reduced investment by FPIs and the outflow of funds as investors seek higher returns in the US market. Now, but despite this, the withdrawal from the debt markets, it remains minimal at around 4,000 crores, indicating that Indian debt markets decreased dependence on any specific market, including the US. Krish will take up this slide.
So how liquidity and inflation basically impact bonds. So inflation reduces the value of money, as discussed earlier, and it makes the liquidity constraint more binding. Now, an increase in liquidity is required to cover inflation and the GDP growth of the country. The lack of liquidity that takes place in the economy, it has a direct impact on the bond market. There is a demand fall that you can see because consumers do not have money to spend, and a hike in the borrowing cost reduces the demand for investments, leading to prices getting corrected and an increase in the price and a reduction in the prices. The RBI amends the monetary policy and it either tightens or loosens the monetary policy to maintain that balance of liquidity in the economy and with the end consumers to keep the inflation in check. Now, the increase in liquidity in markets also triggers the inflation, and hence it needs to be in constant check by the RBI and the regulating agency, which is the central bank of the country.
So we'll conclude this with a short summary of what we've of all the above past slides. But before this, we'll conduct our last poll here.
How do rising inflation impact the Indian debt market and foreign portfolio investor flows? A, FPI flows increase, leading to higher investment in the Indian market. B, FPI flows decrease, resulting in reduced investment in the Indian market. C, FPI flows remain unchanged, maintaining the current investments. And D is FPI flows become unpredictable, causing inflation in the Indian market.
Causing fluctuations in that.
I'm so sorry, fluctuations. Yeah, I think we should end the poll here. And about 70% of you all have gotten it right that the FPI flows decrease, resulting in reduced investment in the Indian markets.
Yeah, so we come to an end with our slides, and we'll quickly pick up some questions from the audience for you.
Yeah, we'll do that. We'll pick up a couple of questions and we'll answer them, the questions that you all have been asking.
Okay, so we have a question here. Can bonds be profitable?
So bonds can obviously be profitable. Now there is not a lot of movement that takes place in the price like it takes place in the equity market. Usually in the bond market, there is the interest payments that you will receive on a constant basis. And also due to the market conditions, the prices of each particular bond fluctuate and it will either increase or decrease. The correct purchase at the right time for the particular bond will make you profitable and that investment is going to make you money.
Okay, so the next question is, which is the most risky bond?
So I feel that there are certain credit ratings that have been given to each particular bond, the AAA being the highest rating that a bond can achieve, and the D rating, which is the defaulted rating, that is the lowest rating that a bond can achieve. What I feel, so basically the D rating is the most risky bond that a investor can invest in because it's probably the company that has already defaulted on its interest payments and it's not going to pay you interest, or that companies are probably in liquidation phase where the company is probably going to shut down. So anything below triple B is considered as a riskier investment.
We'll take up a couple of questions because I think we are running short of time here. So we have a question: what kind of bonds should I invest in?
So I think it's a very generic question that what kind of bonds you should invest in particularly. What I feel is that you should consider your risk appetite and you should also consider your investment amount that you want to invest in. and the investment period that you want to hold that investment for. Considering all of these three situations, I feel that there are different criteria of bonds that will be available for you in the market.
We'll take up one more question.
Yeah, definitely.
So
we can take up this question.
We'll take this up. So somebody wants to know how much TDS is cut at maturity of bonds.
So basically, whenever a investment is there in any particular bond, the interest payment that you'll receive on that particular bond that you are holding, 10% TDS is straight away cut on those interest payments, and at maturity, the principal amount that you receive, and if you and at maturity, there is a principal amount that you receive. Now, if you sell that particular bond before maturity in a profit, then you will be taxed according to your tax slab. But the interest payments that you will keep receiving while still holding that particular security, you will be cut 10% on TDS.
Yeah, we'll take one last question, which is quite related to the webinar. It says how inflation can be checked by bonds.
So as I had explained earlier, that when we look at SLR securities, that is GSEC, higher the inflation, higher will be the demand for the yields. Because whenever there is a erosion in the purchasing power of certain consumers, the fixed interest payments that the bond pays out to the consumers reduces in value, right? When there is a reduction in value of those particular interest payments, then the investors will demand a higher yield in a higher inflationary time. So during a higher inflationary period, there will be higher yields that will be provided.
So with this, we come to an end of our webinar. And for any further queries, you all can log into our website. The details have been given, has been mentioned here. You can send us an email for any further queries. And thank you so much, everyone, for attending the webinar. Thank you, BSE IPF, for giving us this platform. Hope we were able to enhance your knowledge and help you understand the impact of inflation and bonds.
Thank you so much,
Thank
everybody.
you.